And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is, the end of October here as we wrap up this week. And of course, that's also getting us into the two largest weeks of earnings reports. This week and next week will be a lot of the big heavyweights. We're going to have lots of comments this week from Microsoft, Meta, Google, Apple. Going to be very, very big week earnings-wise. That's going to wrap up the month. That also begins to open up the buyback window as we get into November. So this week, very important as we move into the end of the month, and we'll see how markets are going to do, of course, with the earnings announcements. But so far, earnings announcements have been great. We've got an 85% beat rate of the companies that have actually reported so far. And again, we're going to have a lot more this week, but we're currently running at one of the highest 5-year averages of beat rates right now for earnings as we go through this season. Also importantly, there have been virtually no negative comments about macroeconomic environments. And so again, not a lot of concern from companies about, we're seeing slowing economic backdrops, anything like that. So again, very positive, upbeat and earnings season so far. But again, we did come into earnings season a little bit with lower expectations. So we kind of really overset that bar to the low side, which is allowing a lot of this beat rate to occur. But again, it's been very supportive of asset prices, markets sitting at all-time highs as of Friday. Of course, that's also part of the markets being driven by news from the Trump administration and from Scott Bessent over the weekend that basically we're very near a trade deal with China. So again, we have gone back and forth. But again, markets going to be up this morning decently. Dow's going to be up about 300 points this morning at the open. S&P is going to be up about 88 bips. Be careful with this a little bit because we've heard this news before. We've been back and forth with China really ever since Liberation Day. And, we had a deal with China, then we didn't have a deal with China, and there was going to be a very aggressive, another 100% increase. Market sells off 2.7% a couple of Fridays ago. So we've been back and forth on this. Well, over the weekend, we're now back to statements, two statements really. This morning, stocks will be higher, mostly in the technology space. It's going to be driven today really by NVIDIA and Microsoft, Google this morning. Lots of bright green there in the AI kind of tech space. That kind of trade continues on the back of this trade deal with China. However, the material stocks, particularly the rare earth stocks that have been doing very, very well on the expectation that China was going to lock down some of the exports of rare earths, that's been delayed. And of course, China produces about 60, 70, 80% of the world's rare earth metals, and they refine 90% of rare earth metals. So again, they're even importing rare earth metals to refine them from other countries. So again, that potentially given a lot of boost to those stocks. Well, those stocks are down fairly sharply this morning. MP Materials, others are going to be down 5, 6, 7% this morning after being down on Friday as well on kind of the back of this deal being cut with China. So again, though, be a little bit cautious here. Just, it's good we're getting a deal done with China. This was the big one. We've talked about this ever since we started with this whole tariff announcement thing, right? It's always been China that had to get resolved. It's taken a while to get there, but apparently we're getting very close to a deal. We'll see if it sticks. We've heard this news before, and then China was apparently not honoring their deal. We weren't honoring our deal, whatever. And so we got back to more tariffs on China. So we'll see if, how this goes. But again, markets are going to be up very nicely this morning. And again, that kind of sets us up for a continuation. Again, as we move into the last couple of months of the year, as we've been talking about, the backdrop for the markets is still very strong. In fact, let's just talk about that right now. Here's what you need to know before the bell. So on Friday, markets did set all-time highs. We came down, again, like I said, a couple of Fridays ago, we had that big sell-off on expectation that we were going to put a big tariff on China. That was quickly resolved following Monday. And again, since then, market's been slowly kind of climbing back up. And then on Friday, broke out, set new highs. So that's all very bullish right now. We triggered a MACD buy signal on a momentum basis. Relative strength is improving. So again, all of that very supportive of the current rally. Again, markets are going to be up again this morning, so we're going to kind of go back to setting new highs on a daily basis as long as the market can continue to grind higher here. But again, as we move into the end of the year, a couple of things here in particular that can kind of help support this rally. Now, this doesn't mean we're not going to have little bumps and dips along the way. Okay, we're going to have that. We'll have a day or two of sell-off here, day or two of sell-off there for whatever reason. We're going to get mutual fund rebalancing in the first couple of weeks of December. Markets usually decline on that data. But between now and the end of the year, markets should be higher from here because of corporate buybacks going to return. That's going to be about $7 billion a day in corporate share buybacks that's occurring. That'll help support asset prices. Moving into the end of the year right now, systemic trading, CTAs, hedge funds are all underweight equity exposure. Overall sentiment positioning are a bit to the negative side right now. So again, that they've got to kind of regross up going into the end of the year. So that's going to provide some additional buying. And then, of course, also between corporate buybacks, that you've also got earnings. And if earnings continue to be as good as they are, that's going to help keep the momentum in the market. So momentum, which has already been strong, should continue over the next couple of months, and particularly as we get into the year end where we've got to start doing window dressing and positioning for the end of the year for reporting purposes. That's going to that's going to kind of set more additional buying power into the markets because, again, the performance chase for professional managers to report good numbers by year end, that bar is being lifted. We're up about 15% year to date. A lot of professional managers right now lagging that index a bit, so they're going to have to play catch up over the next couple of months. So all of that, and now just having said that, none of that's a guarantee that asset prices will be higher. So again, we still have to manage risk, but on a relative basis, the bias to the market should be higher right now through the next couple of months as we get into the year. But again, something else happens, we get another, this deal with China falls apart, whatever. There's certainly risk. So again, don't mistake that this is a totally risk-free environment for investing. But the bias is to the upside over the next couple of months, which suggests that we want to remain invested in the markets for right now. And again, this has been a good year for all asset classes. Gold's up, Bitcoin's up, bonds are having a very good year up. They're about 5% this year so far. And then add into that the income stream, another 4%. They're gonna yield around 9% by the end of the year at current pace. So again, it doesn't really matter what asset class that you're in. You're having a fairly decent year performance-wise. Just don't forget to manage the risk because, again, as we get into 2026, we're going to start having some other issues, both economically, earnings-wise, et cetera, as we get into 2026. Expectations are still way too high going into next year, and there's a lot of apparent risk that's starting to kind of build up in credit markets, et cetera. I want to pay attention to that. But again, for the next 2 months, we're okay. That's what you need to know before the bell this morning. When we come back, we're going to talk a little bit about the most dangerous era, kind of a byproduct of what's happening in the markets right now. We'll talk about that next on The Real Investment Show. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
And welcome back to the show, of course. So over the weekend, all my kids came into town. My wife had her third chemo treatment on Friday, so she was kind of laid up all weekend. So the kids came home from college for the weekend just to check in on things. So we're all sitting around talking, and my wife starts talking about grandkids. She's very excited about having grandkids. My girl's not so excited about being parents yet. So my wife comes up with a really good idea. I think it's a good idea. We're going to adopt kids and then give them as Christmas presents to our kids. That way we can have grandkids.
What fun.
The girls weren't so excited about this idea. But my wife's very excited about this.
Brilliant.
It's brilliant. It's just adopt some kids, give them away as Christmas presents, and then we have immediate grandkids.
I like it.
Yeah. But yeah, she's very excited about grandkids, and It's the girls are at that age. It's like, not yet, Mom. I'm not ready.
The Roberts legacy continues.
Well, we'll see. We'll see. Again, the girl's not really excited about this idea. But anyway,
Put those grandkids in the will, though, and it's ironclad.
exactly. Yeah, exactly. Just skip our kids and put all the money goes to the grandkids.
There
If you
you
have
go.
grandkids, you're in the will. This is a good idea.
Yeah.
We may have to actually explore this a bit.
Glad you thought of that.
So anyway, a couple of things to talk about this morning. I wrote an article on Friday talking about the most dangerous era, and this was originally an article that was produced by, I believe it was Market Watch, if I'm not mistaken. Yeah, Brett Ahrens over at Market Watch. Brett writes some really, really good stuff, and he was talking about this idea, and the title for his article was called "The Dumbest Stock Market in History," which was just what got my attention to start with. Right. Well, and we actually tried to get Brett on the show. So have Michelle reach out to him, see if we can get him on. But he said in this article that he believes it's the most dangerous era. And the phrase really isn't hyperbole. And it reflects kind of the structural distortion that we see going on in the markets. You know, right now we have extreme valuations pretty much everywhere. Cape's trading at 40 times earnings. And again, people ignore Cape because it's 10 years trailing earnings, and because valuations have been high and the market hasn't crashed, that means the indicator's broken. That's not the way valuations work. Valuations are simply a reflection of what future returns are going to be in the long term. So over the next 10 years, what your returns will be. Higher the valuation, lower the rate of return. But in the short term, it's just a reflection of sentiment, right? We're all willing to overpay for things because, well, prices are going up. So why not buy it, right? It doesn't really matter what the fundamentals are as long as things are going up. We just kind of buy it. And this has led to a lot of this extreme valuation in kind of really multiple areas of the market. And in Brett's piece, he really put it kind of bluntly. He says, at one level, there is no doubt that this is the dumbest market in history because at this point it's completely dominated by passive index investing. And that dominance means that we are now in a state where market mechanics are overriding fundamentals. And again, we ignore that fact because markets are working. But at some point, the fundamentals and the valuations do matter. And again, when you talk about valuations, right? 26 times, forward earnings, 24 times forward earnings, 26 times trailing earnings. And, in particular, here's a chart of the Buffett indicator. This one gets a lot of traction because that's at the highest level in history. We're currently trading about 200 times GDP. So, or 200% above GDP. Now, why is that? Why is market cap to GDP important? Well, in order for companies to have earnings, that has to get derived from economic activity. And so when the markets are trading well in excess of what the economy can actually generate in earnings, this is the thesis, then you've got potential problems, right? So we're paying up for earnings that the economy really can't generate. It's like my dad used to say, is like, you're writing checks your ass can't catch, can't cash, right? That's kind of what the market's doing. And that's okay, but it comes with problems at some point in the future. And see, there's the caveat, right? Right now, everybody ignores stuff like that. You can take the chart down. Everybody ignores this stuff right now because, again, it doesn't matter. It's like, valuations, right? Markets are going up. I'm just buying the most aggressive stocks I can buy. Right now, the performance of stocks with negative earnings growth are outperforming stocks with positive earnings growth, right? That should not be the case. I mean, we're talking about stocks that are near bankruptcy, trading massive upticks. Just recently we talked about Beyond Meat, which had this massive boost. This company's on the verge of bankruptcy. There was always a stupid stock to go public to start with, but, people bought it on this idea that we were all going to become vegans, right? And, that didn't last very long. Reality shows up. I remember during the Great Texas Freeze, that you go to the store, you couldn't buy, there was like no groceries in the store, right? You couldn't buy anything because everything was frozen. But the Beyond Meat section completely full, right? Nobody was buying that. Everybody was buying everything else. So that was a really good indication that the stock didn't have a long future, and it's basically on the verge of bankruptcy. Well, we've seen lately that stocks had a huge jump because meme stock speculators jumping in, running it up. Stock's gonna be down a bunch today because that's reversing. But that's what people are buying. We're not buying fundamentally strong companies. We're buying stocks that are the most shorted, that have the potential for the biggest moves. And we're doing that not only through, as we've talked about before, we've written some articles recently about leverage. This past weekend's newsletter was all about leverage. I'm going to show you some charts on that here in a minute. But we're doing it on leverage. We're doing it through options. We're doing it through the most aggressive trading tactics that we can find because that works. And we're now doing it through things like 5 times leveraged ETFs, which have never before existed in history. And not only are we buying 5 times leveraged ETFs, we're buying 5 times leveraged ETFs on margin to get even more bang for our buck. But what this shows is really a couple of things. One, it's just showing the speculative attitude of investors. And 2, we now have a market where capital flow is automated. And what does that mean? And we've talked about this to some degree before, and it's kind of an important comment to revisit. But I wrote about the issues of passive investing previously, and this is the unforeseen consequence of this development in the markets. The idea was originally that we had mutual funds. So we have to go back in time now. We have to jump in the time machine, and we have to go back in history for a minute. So back in 1914, when I was born, there were no such things as mutual funds, right? So we had the big run up in 1929, the market crashed, right? And so we said, okay, banks and Wall Street can't play together anymore. That's not good. So we formed the SEC, blah, blah, blah. And back then, all we did was trade stocks, right? The only thing available at the time was to trade stocks. Now, just bear with me for this story for a second because it's very important to how we got to where we are today. In the late 70s, there were a few mutual funds. And these were companies that started, and they would buy a basket of stocks and create a mutual fund, and then investors could invest in these mutual funds, right? So we had American funds, American Growth Fund, those type of things back in the late 70s. But still predominantly, despite the fact there was this handful of mutual funds that people could invest in, predominantly the market was driven by stock trading. And, there were stockbrokers, and they would go in every day and they had to sell a stock to somebody during the day for commission because that's how they got paid. And that's how Wall Street got paid. Well, one morning, and the problem with that is it's fine, right? As long as you're able to sell something every day. So your profitability every day on Wall Street was driven by the ability to sell stocks. And so stockbrokers are calling clients and calling, investors and calling people going, hey, I've got a deal on a stock for you and want to buy it. And that's how most of the action occurred. But that was very unpredictable cash flow wise. And so in the early 80s, mutual funds were starting to become more dominant. And they still weren't huge, right? But Wall Street sat around and goes, you know what? We need to shift our focus from stocks into these mutual funds because we can now annuitize our revenue stream for the entire year. So we know on January the 1st, if we've got $100 million, if I'm Merrill Lynch, and I can get $100 million put into a mutual fund that charges 2% a year, and that's what the fees were back then, 2 and 3%, then I'm going to know that I'm going to make on that $100 million at 2%, I'm going to make on day one, right? I mean, January the 1st, I've already made $2 million this year because that's when I'm going to bill in fees. So it annuitized the revenue stream for Wall Street. And so Wall Street changed all their marketing from stock investing to buy and hold investing. Just invest in these mutual funds. If you're a retail investor, buy these mutual funds, hold on to them. Don't worry about what the market does. and just keep paying us a fee. This was great. Wall Street made billions on changing the narrative of investing and how investing worked. But the problem with mutual funds is that you could only trade your mutual fund at the day-end price, which was fine. Nobody really cared. You sold your mutual fund during the day, and you got whatever the closing price was at the end of the day. It's fine. Nobody cared. But as we started to move into the late 90s and we started getting real-time information and all this stuff that's going on, the demand for product from clients was I want to be able to trade this fund intraday. So ETFs were born. ETFs are great. You could buy a basket of stocks. Wall Street still collected their fee, and you could trade this basket intraday. It gave a lot of liquidity to the markets, and it worked well. In fact, it took off, right? Today, these ETFs now make up more funds than mutual. There are more ETFs than mutual funds, right? And as a percentage of the market, they have a bigger percentage than mutual funds. So a lot of money is poured into these ETFs. And as more and more money is poured into ETFs, people have come out with more and more variations of every type of ETF, right? So, if you're a fund producer, there's a lot of companies that all they do is produce ETFs. They just produce funds of types. They charge a fee and they get people to invest into them, right? And that's how they make their money, is on this fee. And that's great. And so you can trade your brains out on ETFs. And this is kind of the misnomer of ETFs. People go, oh, well, ETFs, that's passive indexing. Not really. That's not passive investing when you're investing in ETFs, because people are trading ETFs constantly all day long. And there's more and more demand for ETFs. As there's more and more demand for ETFs and leverage and everything else, then Wall Street's more than happy to provide new products. So the more that retail investors want in terms of ETFs, the more that Wall Street's willing to produce. And that's where we are today, right? We have this plethora of ETFs out there that all pretty much own the same stocks, right? You think about Apple as an example. It's in 450 different ETFs. NVIDIA, it's in like 500 different ETFs, because you have technology ETFs, Apple, NVIDIA are in that, right? You have semiconductor ETFs, NVIDIA's in that. You've got mega cap growth ETFs, NVIDIA's in that. You've got momentum ETFs, NVIDIA's in that, right? So just every time somebody brings an ETF to market, they're all buying the same stocks. So every time somebody puts $1 into these stocks, they're all buying the same stocks. And that's why we have now and this is what I was talking about earlier, is about market mechanics have overtaken fundamentals. It's just the flows. I wrote about this previously. It said passive investing has grown from a niche strategy and the dominant force in equity markets. Index funds and ETFs now account for over half of U.S. equity ownership. These vehicles allocate capital based on market capitalization, not valuation, fundamentals, or business quality. As more money flows into the funds, the largest companies receive the lion's shares of new capital. That creates a powerful feedback loop where prices drive flows and flows drive price. That's an important statement. This all goes into Brett Aaron's statement about this being the most dangerous era in the markets, because it's simply about flows. And so if you take a look at, kind of how the market's broken down, 10 stocks make up roughly about 36% of the overall market. So 36 cents out of every dollar that goes into an ETF goes into those 10 stocks. And that's why NVIDIA and Apple and Microsoft just keep going up. It really doesn't matter what else is going on. Those stocks keep going up because everybody's buying these ETFs. The top 10 stocks make up the same amount of the market capitalization as the bottom 440. So out of 500 stocks, 10 stocks make up the same amount as 440 stocks. That just shows you the problem with market capitalization and how it's kind of broken in the markets. And this is why also, if you take a look at the equal weight indexes, they're grossly underperforming the cap weighted indexes because of this cap weighting issue. So that provides the mechanical problem to the market, this kind of draw, and this is what he's talking about, is this draw of capital into the market only goes into the same stocks over and over again. And again, this doesn't matter whether it's valuations or fundamentals. It doesn't matter. Money's flowing. The money is trapped into a flow into these same stocks. And that process just repeats on a daily basis. And so it continues to distort the market because every day the market goes up, more people put money into the ETFs. And also just think about all the automated investing out there, like 401k plans. Every 2 weeks, people are funding their 401k plan that's automatically getting vested into these same holdings. And so that just continues that feedback loop over and over as we go forward, which keeps driving the markets higher. We get more deviated from long-term means, and it creates more fragility in the overall markets. And again, as I was talking about just a second ago, if you take a look at, kind of the number of passive ETFs and mutual funds, passive ETFs and mutual funds that are what they call passive, and these are what are just invested in things like an S&P 500 index, right? These aren't specialty ETFs. That's about 55% of all ETFs that are out there. So about half are just buying indexes. So you've got about half of all the ETFs buying the same stocks because they're all buying the same index. So this is the kind of the core mechanism of flow concentration. So as assets flow into these index funds, that creates a distortion in price formation. It creates market concentration, and that compresses, at least in the initial phase, it compresses volatility. Because again, the money's just flowing in and it just becomes an automated process. So it suppresses volatility and it concentrates the market. So the problem that becomes out of this, and this was a academic research paper that was put out. It's called Passive Indexing and the Rise of Mega Firms. And the authors demonstrated that flows into passive funds disproportionately raise the stock prices of the economy's largest firms, especially those in high demand by noise traders. The result is that the aggregate market might rise even if the flows come purely from reallocation from active to passive strategies. And so because passive flows inject money mechanically in the markets, that increases the idiosyncratic risk of volatility in these larger firms. That increased volatility discourages arbitrage. Now, again, and you have to understand that in the markets, whenever you're doing something in the market, you're buying a call option on a stock. Somebody in the market has to arb that, because they have to offset that risk of that contract they just sold you. So for every transaction that you do in the market, there is an arbitrage against that. And this is why things like, I get a lot of emails like, why don't I just buy stocks the day before they pay the dividend? And then I collect the dividend, and then I sell the stock the next day. Well, that doesn't work because somebody's already arbitraged that in the markets. They've already reduced that risk in the markets, which is why it doesn't work. So increased volatility discourages the arbitrage from the active investors who might otherwise correct those mispricings, and that allows the distortions in the markets to exist. And really, I should say not exist, but to persist in the markets. So what the research paper found was that the largest firms in the S&P 500 experienced the most significant returns, which is not surprising. Because why? All the money flows into the same stocks. Morningstar wrote an article kind of warning against this problem. They said that the surge in passive indexing doesn't just mirror the market, it shapes it. What was once a price-taking approach is now a price-setting force. This also leads to several distortions that pose significant risk to investors. So here's the risk that they laid out. First one is the pollution of valuation signals, right? We've already talked about that. So valuations used to provide a signal to investors that there's risk to the markets, right? You're way overpaying for stocks from what they can earn. The valuation gave you a signal, but that's been distorted now by this passive indexing flow. We no longer pay attention to valuations because prices just keep going up and it doesn't matter. So according to Morningstar, they say when mega firms get capital for size rather than merit, valuation ratios become less meaningful. A large and popular firm in the index keeps attracting capital regardless of profit margins, growth prospects, or leverage. Apple's a really, really good example of that. The feedback loop itself is self-reinforcing. Size begets inflows, which beget price increases and more size. Again, Apple's a really, really good example of that statement because they haven't really grown earnings to any great degree. It's a big firm. They produce a product like the new Apple 17 is out, 17th version of the phone. It's a little thinner, but there's no great innovation into the phone. There's really no reason, unless you're just one of these people that serially upgrade, there's really no reason to go buy the new Apple because it's really no different than the old Apple to any great degree. But that's being reflected in the revenue growth of the company. But again, stock keeps going up, setting new highs. Why? Because it's the largest stock in the index and it keeps one of the largest, not the largest, but it's one of the largest. It used to be the largest till NVIDIA took it over. But it's attracting those inflows, keeps the price going up. The second thing that Morningstar pointed out was the causality of liquidity. I thought this was an interesting point. Passive dominance gives a veneer of liquidity, especially in bull regimes. But in stress, passive funds become sellers. Forced redemptions trigger mechanical selling of underlying equities. That selling pressure concentrates on the very names already inflated by the markets. You see this like a couple of Fridays ago, that 2.71% decline in the markets. You saw that exact thing occur. The biggest stocks in the index were down the most that day, dragging the whole index down. Structural fragility, as they conclude in this part, structural fragility serves as an accelerant to corrections. And again, this is part of the conversation we had this weekend on leverage in the newsletter, which also provides additional fuel to those declines. And this is why in the future, these 3% in a day declines are going to become commonplace. You're going to wake up one morning, the market's down 3 or 5% a day. That's going to become much more normal in the future because of the way the market dynamics are structured. This low volatility, compressed price action, when it breaks, you're going to have very, very sharp corrections. So you're going to have to build that into your process of managing your portfolio. Third, is that Morningstar points out, is that concentration hurting risk. Right. And so we've talked about herding a lot here on the show. It's one of the psychological flaws that we all fall into. But Morningstar points out many portfolios assume diversification. This is a very important point. People look at their portfolios and they go, oh, yeah, I've got small cap, mid cap, I've got large cap, I've got international. Right? So I'm diversified. But you're not, because the correlations of these assets are now all moving towards one. And so if people just assume diversity, and the other thing people look at is I own an index, so I'm diversified because I own the whole index. You're not. Proper diversification vanishes. This is according to Morningstar, not me. Proper diversification vanishes when an index is heavily weighted in a few mega cap names. Morningstar's analysis underscores that distortion, and the academics back it. The rise of mega firms driven by passive flows concentrates systemic risk into just a handful of names. So in short, this passive indexing underwrites the market, where the most prominent firms dominate by default, not by merit. And that is, to Brett Aaron's point, is that has now led us into this most dangerous era. And the point about this, notably, is this leads to the whole issue of bubbles. Bubbles don't form, they evolve. Speculative names are not a modern, invention. This has been going on since the beginning of time in the markets. They just recur with different assets, new technologies, updated language. But, one time railroads were speculative. One time telecoms were speculative. One time .coms were speculative. We've gone through this numerous times. And what remains constant for investors is the core mechanism, which is the promise of easy wealth, mass participation, innovation, and it all seems too powerful to fail. This time is different because today's environment mirrors more of the 1920s, not by coincidence, but really kind of by design. And that's a feature of this environment that we're in, is this speculative risk. And this is very similar to what we saw from 1920 to 1929. Banks were loaning money to individuals, i.e. margin, to buy the stocks that the banks were putting out for IPO. And so they would loan the money to the investors. The investors would buy the IPO, which created demand for the IPOs, which then allowed the banks to loan more money to individuals to buy the next IPO. And so it just created this self-reinforcing loop of asset creation and speculation, which is exactly what we're seeing today. The more speculative we are, the more aggressive we are about buying stuff, the more that we take out on margin debt, and the more product that we create, or the more product that we demand, Wall Street is more than happy to create it. And the more aggressive we want it, they're happy to create it more aggressively. So this and again, we can kind of look at things like, MicroStrategy, and you've got a 2X version of MicroStrategy. You've got a 5X version of MicroStrategy. It's leverage on a company that's already employing leverage to create returns. This was a note from Brett. In the 1920s, investment trusts were sold to everyday investors as a safe way to share Wall Street's boom. In truth, they were layered with leverage internal cross-holdings that no one could untangle. When the market turned, they collapsed. The modern version is private equity funds inside 401k plans, crypto ETFs, and built-in leverage and semi-liquid vehicles promising stable returns and from inherently illiquid assets. As the New York Times recently noted, these vehicles are pitched to ordinary investors as opportunities once reserved for the elite. Still, they obscure risk behind slick packaging and limited redemption rights. That's the risk. So, again, it's just something to think about, because what makes this period dangerous, and look, I'm not saying that the markets are about to crash. I'm not saying that at all. That's not what the purpose of this article that I published this morning is about. It's just about being aware of the risks that you're taking. So when you're managing your portfolio, you're careful about layering risk, particularly if you're using leverage. So what makes this kind of a dangerous is this illusion that we have of liquidity. And in reality, the markets are not liquid because all the money is concentrated in just a few assets. That's more of an issue of fragility than liquidity. Private equity firms now mark assets with little market validation. They just do mark to market. They just market to what they think it's worth. Redemption, there's redemption limits on private equity, like 5% cap in funds with Blackstone's BREIT, that prevent investors from exiting but do little to prevent panic. So the problem becomes when prices stop rising. This all works as long as prices rise. The problem comes when prices stop rising. And you got a little bit of a taste of that back in April when we had that near 20% decline, and it happened very quickly. That's going to be more of what the future looks like. Instead of things being down 0.5% or 1%, it's going to be down 2 or 3% in a day, 4% in a day, 5% in a day. And so you buy this asset, this asset's just going up, and the next morning you wake up, you're down 5% in it, like right away. That makes it difficult to manage the portfolios. So again, while I'm not suggesting that the markets are about to crash, I'm not saying that at all. Corrections will occur. And when those corrections occur, they're going to be fairly brutal. And this is the part that you've got to kind of factor in. So, stress test your portfolio a bit. What happens to my portfolio if everything reverses in a day? Because reversals won't be segregated to just a handful of stocks somewhere. It will be a market-wide liquidation. It'll be across all asset classes at one time because they're all correlated with each other. As Brett kind of concluded, he says, index buyers buy stocks without any regard to valuation. Index funds chase the crowd. Index funds are the crowd. And that's the problem with a lot of these ETFs that we have today, is that it is simply just a reflection of the crowding of the markets. And the irony of the crowd is that it tends to be fairly brutal, because when the herd turns, right? If you ever go look at a herd of cows, they all face in one direction, right? When they move, they all move in one direction. That's the herd. That's what happens in the markets. But when something comes along that spooks the herd, it can change very quickly, and it turns in the other direction and runs in the other direction very rapidly. And so the irony of the crowd is that it's a fairly brutal structure. We design these passive strategies to remove the emotion, right? We're supposed the whole purpose of these ETFs was just index and chill out. Don't worry about the market from one day to the next. It's fine. It's going to go up, it's going to go down, but over time it'll be higher. That was the thesis. And that worked when there were just a few ETFs in the markets, but now they're the predominant force. They shape the markets. The crowd is the market for the most part. So when the crowd turns, and this is the big risk, right? People talk about, the next financial crisis. The risk to the markets is something happens, I don't know what, that causes people to start dumping ETFs simultaneously. Maybe that never happens. Maybe we're in an era where nobody ever sells anything again. But if, in the event, people start selling ETFs, it's a problem. Think about a theater, right? We talk about somebody going into a crowded theater and yelling fire. What's the problem with that? The problem is if you can think, when you go into a movie theater and you're sitting in there, right? So there's like 300 seats in this movie theater, and they tell you right before the movie, they say, ladies and gentlemen, please look around and find the nearest exit to your seating location. If something happens like a fire, walk calmly to your exit and exit the building. That's fine. Except what? You've got 300 people and you've got 2 doors up front, 2 doors in the back. So when everybody's trying to get out of the theater at one time, those exits become very, very crowded. And it's very difficult to exit the theater in a timely manner. So kind of the point is in your portfolio is to think about these risks and understand that we are very late stage in this cycle. That doesn't mean to sell your ETFs. It doesn't mean to get out of the markets at all, because markets are still going up. But you may want to notice where the exits are and sit a little bit closer to the exit, just in case. Because when you start thinking about this, the longer that this lasts, the bigger the unwinding will eventually be, because we're getting so distorted from long-term growth trends that the reversal back to the growth trends is going to be problematic. Just for instance, if you just think about, as an example, where we are today, if you get a reversal back to kind of the 40-week moving average, that's about a 30% retracement from here. If you get a retracement back to the highs of 2019, right? Just before we had the pandemic drawdown, which was the last time that we retraced back to the 40-week moving average, that's a near 50% drawdown. And the irony of that is you can have a 50% drawdown in the markets and still be in a bull market trend, right? So, you go back to 2008 and you think about the panic we had with the 50% drawdown. It was terrible. We broke bullish trend lines. We did everything. It's terrible. Now you have 50% correction. We're so deviated from that long-term trend that you're still in a bull market. All you did was revert back to the trend. That's the problem with the market, is just these extreme deviations. So anyway, that article's on the website. And again, just kind of some thoughts I had thinking about, and again, there's a really good article by Brett Aarons, and that's worth a read also, just kind of his point. But it's just something to consider. And again, as I said, I just want to touch real fast on, and then I'll kind of wrap things up here. But this weekend in the newsletter, I went through talking a bit about market leverage. And when you start looking at, cash levels of investors, right now we're sitting at some of the lowest levels of investor cash on record. So as people thought about, well, there's a lot of cash on the sidelines. No, cash on the sidelines doesn't exist. It's a myth. Most of that's corporate operation money. It's never coming into the markets. Investable cash that investors have is at very low levels. Some of the lowest levels we've had in recent history. So in other words, everybody's kind of in the markets already. And if you take a look at margin debt, one way I look at margin debt is two things. One, how fast is margin debt leverage accelerating, and how deviated is it from long-term means? Right now, margin debt is about 40% above its 4-year moving average. And the acceleration of that debt over the last few months has been very, very sharp. So again, when you're having a very sharp increase in leverage, that is simply just a notation that investors are becoming much more aggressive in the markets. And at the same time, you've got a record number of companies now, as I said, when there's a lot of demand for risk, Wall Street is more than happy to provide the product. And there are now more leveraged equity. We're at an all-time high in the number of leveraged equity ETFs. There's 700 of them in the markets. They're all providing leverage to the markets. And most importantly, just notice the sharp increase in demand for those. I don't produce an ETF if I'm not getting asset flows. So again, just the total demand for that is increasing sharply. The amount of leverage that we're taking on is increasing sharply. Options volume retail options now make up about 60% of the total options volume on the markets. Again, it's just a cautionary tale. Doesn't mean the market. This is, and by the way, all of that is bullish in the short term. All of that supports the rise in the markets because, again, it's just pulling money from every source available. I ran out of capital to invest, so now I'm borrowing money to invest. So that fuels the market on the way up, but also that works in reverse. Because when the liquidations occur, it is not, and this is what I discussed in the newsletter this weekend, is that when margin reverses, it's not a choice of liquidation. It is a forced liquidation. You get a call from the brokerage firm saying you need to sell today to meet your margin. If you don't do it by end of day, we will do it for you at the end of the day, and it is indiscriminate. That's the risk that fuels the next correction when it occurs. So again, this is just the things to think about in your portfolio. Is understand this is all bullish. This all narrative is bullish in the short term because it's a self-feeding cycle in the markets. It also works in reverse. All right. Enough doom and gloom for the morning. Markets are going to be up nicely this morning. Bitcoin's up this morning. Euro's up this morning. Everything's up. So again, it'll be a good day back in the China news. But again, just the whole purpose of this conversation, don't ignore the risk in your portfolios. Be sure and like and subscribe to the channel. We appreciate it very much. And to get by the website, the article's posted this morning. If you want to see all the charts and graphs, read the whole article in detail, it's on the website, realinvestmentadvice.com. It's also on X at Lance Roberts and on Twitter at Lance Roberts as well. Follow me everywhere. It's easy to find stuff. Have a great day. We'll see you back here tomorrow with John Penn. Don't go away.